Hi, everyone, and welcome. We've got something really important to talk about today, a huge change coming to UK tax law. This is a special briefing we've put together with the experts over at My Tax Accountant because, honestly, this could have a massive impact on your family's future. We're going to break down exactly what's happening with pensions from 2027 and, most importantly, what you can actually do about it. So let's dive right in. Okay, let's just start with a really stark image. Imagine that pension pot you've been carefully, painstakingly building for years. Now, imagine 40% of it just vanishing, poof, gone before it ever reaches your loved ones. Now, I know that sounds dramatic, but from April 2027, this isn't some far-fetched hypothetical. For a lot of people, this is about to become their new reality. So we really need to understand what's going on here.
So here's how we're going to tackle this. First up, we'll get to grips with the 2027 pension tax shift itself. Then we'll look at how your estate is actually affected and run through the numbers. After that, we'll dive into some strategies to protect your legacy. And finally, we'll wrap up with a clear action plan for what you need to be doing between now and 2027. Sound good? Let's go.
All right, let's get into Section 1, the 2027 pension tax shift. We need to understand the fundamental change that's at the heart of all this. Okay, so what is this big new rule that kicks in from April 6, 2027? Well, to put it really simply, most unused pension funds are about to be included in the value of your estate for inheritance tax purposes. For a long, long time, pensions have had this kind of special protected status. They've sat outside of the IHT net. The government's now changing that, bringing them into the main calculation, saying it's all about making the tax system fair.
And this slide really lays it out, the before and after. Before April 2027, your unused pension was generally outside your estate, held in what's called a discretionary wrapper, which usually made it IHT-free. It was, let's be honest, a key tool for inheritance tax planning. But after April 2027, it's a whole new ballgame. Your pension gets included in your estate, treated just like your property or your savings. This basically closes what many saw as a major tax planning loophole and turns what was a safe haven into a potential source for a very large IHT bill.
Okay, that's the real change. But what does this actually mean for your family's inheritance? You know, the so what of it all. Let's break it down.
Right, the first key number you need to know is £325,000. This is your basic tax-free allowance for inheritance tax, also known as the nil rate band, or NRB. Now here's the kicker. This amount is frozen. It's not going up with inflation. It's stuck at that level until at least 2030, which means, in real terms, its value is actually going down every single year. That's a really crucial point. On top of that, there's another allowance of £175,000. This is the resident's nil rate band, and you can get this if you pass on your main home to your children or grandchildren. Now, here's where it gets interesting for couples. You can combine these allowances, so 2 lots of £325,000 and 2 lots of $175,000, that adds up to a potential £1 million that can be passed on completely free of inheritance tax. Which sounds great, right?
Well, here's the number that everyone worries about, 40%. For every single pound your estate is worth over those tax-free allowances we just talked about, it's taxed at a flat rate of 40%. And now, with these massive pension pots being thrown into the calculation, you can see how suddenly a lot more families are going to find themselves tipping over that threshold and facing a pretty hefty bill.
Okay, here's a pro tip, and please stay with me here because this is so important and it catches so many people out. That extra $175,000 allowance for your home, it's not guaranteed. If your total estate goes over £2 million, and adding in a big pension could easily do that, that allowance starts to get smaller and smaller, and once your estate hits $2.35 million, it's gone completely. So think about that. Your pension isn't just getting taxed itself, its value could literally wipe out another tax break you were counting on. It's a double whammy.
Right, that's enough of the theory and the abstract numbers. Let's make this real. We're going to walk through an example to see exactly how this plays out. So let's meet Sarah. She's a 55-year-old freelance graphic designer living in London.
Okay, let's look at Sarah's estate after April 2027. She's got her property valued at £400,000 and some ISAs and savings worth £150,000. Now, here's the game changer. We add in her unused pension pot of £400,000. That brings her total estate to £950,000. She gets her personal allowance and the home allowance, which total £500,000. So we subtract that, and we're left with a taxable amount of $450,000. And 40% of that? That's an inheritance tax bill of £180,000. Before this rule change, her IHT bill would have been minimal, maybe even zero, depending on the details. This single change has created a massive tax liability out of thin air.
But wait, it can actually get worse. And this is what people are calling the double tax trap. If you pass away after the age of 75, your beneficiaries could get hit twice. First, the pension pot gets hit with that 40% inheritance tax. Then, when your loved ones actually go to withdraw the money, they have to pay income tax on it. The effective tax rate in that scenario can be absolutely staggering. It's a really brutal combination.
You know, I saw a comment on Reddit the other day that just hit the nail on the head. It said the biggest revelation is how many people viewed their pensions as inheritance tax dodges rather than pensions for old age. And that's exactly it, isn't it? For years, that's how they were used in planning. This new rule is a massive signal from the government saying, nope, that's over. Pensions are for retirement.
Okay, I know this all sounds a bit doom and gloom. We've laid out a pretty significant problem, but let's shift gears now. Let's turn that anxiety into action. Because the good news is there are absolutely things you can do. There are clear, effective strategies to protect your legacy.
I like to think of this as your protective toolkit. You've got several tools at your disposal, things like strategic lifetime drawdown, gifting from your pension, using trusts and nominations, whole of life insurance, even spousal transfers. There's a lot to consider, but for today, we're going to focus on one of the most powerful and, in some ways, straightforward strategies, the power of gifting.
So, how does this gifting idea actually work in practice? Well, there's a process, and it's built around something called the 7-year window. First things first, and this is non-negotiable. You have to assess your own needs. Make absolutely sure you have enough left for your retirement. Step 2, you withdraw some money from your pension. Yes, you'll pay income tax on this as usual. Step 3, you give that post-tax cash to your loved ones. Step 4 is the big one. You have to survive for 7 years after making that gift. If you do, it falls completely outside your estate for IHT purposes. And finally, step 5, document everything. Keep clear records of the withdrawals and the gifts. It's a powerful way to move money out of your taxable estate over time. Okay, so we've looked at the problem, we've touched on a solution. Now we get to maybe the most important part of this whole discussion, your action plan. What should you be doing right now, today, to prepare for 2027? Breaking it down into a timeline makes it feel a lot less overwhelming. So for the rest of 2025, your job is to audit your pensions, hunt down all those old pots, use the pension tracing service if you need to, and get current valuations for everything. Then in early 2026, it's time to review your will and, crucially, your pension nominations, those expression of wishes forms. You need to make sure they align. By mid-2026, it's time to model your estate. Do the maths, just like we did for Sarah, and see what your potential IHT liability looks like with your pension included. And then in late 2026, armed with all that information, that's the time to seek professional advice and get a formal plan in place.
Look, if there's one thing you take away from all this, it's this. Proactive planning is the key. It's everything. These changes are significant. There is no downplaying that, but they absolutely do not have to catch you unprepared. Knowing what's coming and taking these steps now is how you protect your legacy. Now, it's really important for me to say that the information we've discussed here is for general purposes only. It's not a substitute for professional advice, because everyone's situation is unique, and it should not be the sole basis for your financial decisions. So, for professional advice that is tailored specifically to your unique situation, you really should speak with an expert. The team at My Tax Accountant are brilliant at this stuff, and they can help you navigate this whole pension issue and any other tax questions you might have. Their phone number is +020-8570-8531, and their email is info@mytaxaccountant.co.uk. So I'll just leave you with this one final thought. Your legacy, it's your story. It's so much more than just numbers on a spreadsheet. And planning for changes like this, well, it's really about making sure that you're the one who gets to write that final chapter. Thanks so much for joining us for this briefing. And hey, don't forget to subscribe to the YouTube channel for more clear, practical tax guidance just like this.